in the meantime, take advantage of this pullback in the price of gold. Gold was as high as almost 4,400. We're now down closer to 4,100. Buy some. Silver, I think now buying it below 50 is a great buy because I don't think it will be below 50 for long. And I do believe that 50 will ultimately be the support, even though we're below 50 now. That was the double top. We've taken it out. We've now pulled back. I think the next move will probably catapult it much higher than 50. So you can still buy silver right now. So go to Schiff Gold. Don't just watch the YouTube videos on the Schiff Gold YouTube channel. Go to Schiff Gold. And more importantly, take advantage of a 15% correction in gold and silver stocks.
Peter Schiff, a longtime advocate for sound money and precious metals, urged investors to view the recent correction in gold and silver as a golden opportunity rather than a setback. He pointed out that gold, which recently reached nearly $4,400 an ounce, has pulled back to around $4,100, a healthy dip that presents a strong entry point. Similarly, silver's drop below $50 shouldn't cause concern. Schiff believes it will soon reclaim that level and establish it as new support before launching much higher. For long-term investors, he argues, these temporary declines are moments to accumulate, not retreat. Even gold and silver mining stocks, now roughly 15% cheaper, look compelling at these levels. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I mean, typically, psychologically, you get resistance. We had it at $2,000 gold. We had it at $3,000 gold, though not quite as much as we had at 2,000. But a lot of people would have expected that 4,000 to be some type of resistance that, could cause a pullback, and it may take a little while for the market to muscle through 4,000. Instead, we went through it like a hot knife through butter. Yes, we had a correction, but we fell down to 4,000. 4,000 now looks like the floor for the price of silver. Now, instead of being emboldened by that, because if 4,000 is the new floor for gold, that is great news for the gold mining companies. But you wouldn't know that by looking at what happened to those stocks. The GDX is now down 14.5% from its high last week, and the GDXJ is down 15.5%, and pretty much every silver stock is in a bear market, right? Down more than 20%, even though silver is at 48.5. Which is a very high price for silver. And the fact that it was able to get through 50 all the way up almost to 55, I think should be encouraging news for silver stock buyers because it shows that 50 isn't the ceiling anymore. We went through 50. And yes, we're back below it now, but I doubt we'll stay below it for long. Now, getting back, though, to gold and 4,000, I think 4,000 is the new 3,000. And if you recall, when we got above $3,000 gold, we did dip below it a couple of times, but we didn't stay below it very long. It really was the floor. The same thing is probably going to happen with 4,000. Now, I wouldn't be surprised if the market went back below 4,000, especially since it came so close this week at 4,016. Now, maybe that was the low. Maybe this is the end of the correction. But it's also very possible that that's not the low, that the market retests that number and maybe goes a little lower than that in order to shake out some of the speculators who may be, buying it now and putting some stops below that low or maybe below 4,000, hoping that it won't go down there and trying to get, kind of a low-risk trade where I'm buying gold at 4,100, or maybe they got it a little lower and I'll get out if it gets below 4,000 or something like that. So there could be some people trying to do that and, they may get stopped out. Then again, they may not. I don't know, but I don't even care because I think that if we do go back below 4,000, it's only going to be very briefly and mainly probably just to flush out those stops. And then the market will come back up. So I think we're headed a lot higher. I think the fact that gold went above 4,000 is a very bullish sign. But what's also very bullish to me is how the media, the financial media in particular, is covering gold's rally and, more important, its decline because they're treating it like this is the end of some kind of speculative mania. In fact, I was watching on CNBC today, and they reported some news that came out from the inflows to GLD. And there were very substantial inflows finally into GLD over the last, 4 months. And that contrasts sharply with the earlier part of the year and all of last year, where we had massive outflows out of GLD. Now, the way they covered it was, this probably shows you that it's the top of a mania because the investors were chasing gold at the highs, as if we've seen the highs. We haven't seen the highs, but according to CNBC, maybe we have, because the investors got suckered into the market and bought the high. Now, that's very different than the way they covered news last year when we had huge inflows into Bitcoin ETFs. They didn't hold that out as evidence of the end of a mania, of the individual investor being dumb enough to buy the highs of Bitcoin. The way they covered that was as a positive. They said, well, this just shows that interest in Bitcoin is spreading, right? Now you have more investor interest in Bitcoin, and so it's a good thing. And so money going into Bitcoin ETFs was a positive for Bitcoin, but somehow it's a negative for gold. Now, I think that, yes, it could be a very short-term negative in that we got a correction, right? A bunch of people rushed in, and now we get a correction. And that's probably the last couple of weeks, not the last 4 months, because it wasn't until very recently that gold started rising at an accelerated pace. But I do think that the fact that we finally have some inflow into gold ETFs and that they are significant, to me, does indicate that investors are finally getting interested in gold. Now, they're not interested enough, and there's not enough of them who have gotten interested. But now, after having no interest whatsoever, they're finally starting to recognize that they should buy gold. And I think that that is a good sign, because I don't think that the money that came into ETFs in the last few months is done. That now that gold has pulled back from 43 and change back to 4,100, that whatever interest was prompted is now gone. No, I think that's the tip of the iceberg. We have a lot of money that's going to be following up. Now, yes, there may have been some short-term leverage speculators that got burned because they came in late and they got surprised by a big correction. That's possible.
Peter Schiff analyzed the recent pullback in gold and silver, emphasizing that such corrections are both normal and healthy within a long-term bull market. He noted that $4,000 has likely become the new floor for gold, just as $3,000 once was, and that brief dips below it are more about flushing out short-term traders than signaling weakness. Schiff highlighted how mainstream media continues to misread gold's moves, labeling ETF inflows as signs of mania, while celebrating similar flows into Bitcoin as bullish. In reality, he argued, rising investor interest in gold, ETFs, marks the early stages of renewed confidence in sound money, is simply clearing the way for much higher prices ahead. Let's get into the interview.
Gold is not in a bubble, and that investors remain skeptical and pessimistic and fearful. Right? In a bubble, investors throw caution to the wind, and it's greed that rules the trade. But in the gold trade, it's still dominated by fear. And a good example is the reaction to Newmont's earnings, which were released, I think, last night. So after yesterday's close, but first time U.S. investors could trade Newmont stock in the U.S. because it also trades in Australia, and so it was down last night in Australia. But in the U.S., the first trading was this morning, and Newmont opened down about 7%, despite the fact that it announced record earnings and record revenue. In fact, earnings doubled, more than doubled from a year ago. So again, the price of gold isn't double, but their earnings doubled. And they beat estimates too. But instead of focusing on the good news, investors focused on what they perceive to be the bad news. Right now, in a normal bull market, that's longer going, where you have more optimism. Investors focus on the good news and ignore the bad news. But earlier in the bull market, when there's more skepticism, the bad news seems to get all the coverage. So what was the bad news in the Newmont earnings? Well, Newmont warned that in the current quarter, Q4, their cash flow will be impacted by some severance payments that they're making and some other costs related to construction of some, mining operations, a water facility. I forget the exact expenditures. But those expenditures, unlike the severance were just one time. A Q4 event, the severance payments will be made, and then that'll be it. But the other expenses could be recurring for several quarters, I forget, maybe a year or two, until this thing is completed, in which case then, they get additional production. So they focused, I think, investors on the fact that, wait a minute, there's going to be some negatives in Q4, and so let's sell the stock. But they ignore the fact that gold prices are already much higher, even with the pullback now, than the price they realized in Q3. And probably the extra income they're going to earn from higher gold prices is going to more than offset these costs. So earnings are going to go up. They're not going to go down. And the stock is already cheap. I think now, it's at 12 times earnings based on the earnings they just reported. That's almost a 50% discount to the S&P 500. Yet Newmont is growing its earnings much faster than any of the stocks in the S&P 500. Now, also, partially, the earnings would have been even better in Q3, but their production was down over what was forecast. So they produced a little less gold, but of course they got a lot more money for the gold that they produced. Now, this is classic, that investors react to production delays as bad news. It's not bad news, right? Yes, it impacts the current quarter, but that's just more income for future quarters, because any gold that they didn't mine for whatever reason, whatever delay impacted their production, that gold is still there, right? It's not like rotting. It's not decaying. It's not like, oh, we didn't dig it out of the ground this quarter, so we've lost it. The gold is still there. Now, yes, they don't get to sell the gold this quarter. Maybe they'll sell it next quarter or the quarter after that. So yes, the time value of money, the interest rates. So maybe investors will have to wait a little longer to sell that gold. But since the price of that gold is likely to be quite a bit higher, it's actually a good thing.
Peter Schiff concluded by pushing back against the mainstream narrative that gold is in a bubble, arguing the opposite, that fear, not greed, still dominates the market. He pointed to Newmont Mining's earnings as a perfect example, record revenue and record profits, yet the stock fell sharply. That reaction, he said, reflects lingering investor skepticism typical of the early stages of a bull market, not the end of one. Even as gold prices remain near historic highs, mining companies like Newmont trade at deep discounts, around half the valuation of the S&P 500, despite stronger growth. Schiff believes this disconnect presents an enormous opportunity. When sentiment finally flips from fear to confidence, both gold and miners could reprice dramatically higher. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.